Seattle paying up to 53% more than the national average for gasoline. The stock market is more overvalued than almost at any time in U.S. history, and then the U.S. economy is speeding up despite the shutdown. That and so much more on this week's episode of Elevate Your Wealth.
And now, Elevate Your Wealth with Mark Stimpson and Casey Elkins.
Welcome into Elevate Your Wealth. Your hosts are Mark Stimpson and Casey Elkins. Also, guest on the program today, Craig Roth. And you can find them all at Elevated Financial Management right here in Seattle. And it's all about getting you ready for your retirement. They've got well over 42 years combined experience helping their clients get ready for retirement, certified financial fiduciaries. I'm Morgan Patrick. A pleasure to jump on. We are going to give you opportunities to get on their calendar. These are complimentary appointments. We're also going to give you an opportunity to grab one of their books, and that is complimentary as well. Break the Glass. We'll tell you about that as we move through the show. And as I always do, guys, I start off the show just asking how the week was. Mark, let's start with you.
Yeah, it was really nice. We had a pretty cool trip. We got to go somewhere that's kind of on a bucket list for a lot of people. Got to go to Bora Bora, and we came back. And but what was nice about being there, we were with other advisors from around the country. And even though it was a nice setting, of course, we still shared a lot with what's going on in their offices and in our office. And so it's a really nice way to get other ideas and things that we can bring back home to help our clients to have a better retirement and do things maybe differently than what the big box stores are talking about right now. So again, it was really wonderful to get away and just relax a little bit and come back and gear up for this last couple of months of the year and really, because we focus a lot this time of year. Everybody thinks a lot of places slow down. We actually are going to be very busy both in November and December, so we're looking forward to these last couple of months.
All right, Case, what about you? I know you were on the exact same trip.
I was, yeah, it was great. If you're thinking of going to Bora Bora, I would say absolutely go to Bora Bora. It's everything that you think it is. Yeah, it was amazing. Beautiful trip. Great people there. You know, everybody there was really nice and so friendly and welcoming. And yeah, it was fantastic. Had a lot of fun. You know, as Mark said, you know, we're in this great place and it's exciting to be there and we have a lot of fun while we're there. But realistically, we spend a lot of time working, right? Because we really are sharing ideas with other offices like ours across the country. Yeah. And I that's so valuable to us. It really is, right? And you know what I think is really valuable to our clients. And that's really the key here, right? Is we're doing everything we can to get better, to see what's coming, to get other ideas and opinions and thoughts from other, you know, top advisors from across the country. And we bring all of that back and we start to implement changes into our practice here. And of course, the goal is always just to be better than we are, right? And we're just constantly trying to improve and keep up with what's happening. And so, you know, something that we're really proud of. Like I said, we get to have a lot of fun when we do it, but still something that, you know, it's time away from our office here, right? It is. And it's an investment on our side because it takes time, it takes money to do these types of things. But ultimately, we try and come back with something positive that we can share with the office and hopefully improve in the way that we work with our clients. So
I think it's an excellent think tank. It's a great location, obviously.
Yeah, right.
Yeah, you get together and you guys share ideas, and it's like the top percentage of advisors around the country, and you're all in the same spot, so you can't help but share information on what's working and what people are concerned about across our great country. And then now we're going to stop in with Craig Roth. Craig, did you stay at the office and feed the goldfish? What did you do?
Well, yeah, Morgan. I'm really thankful and feel privileged that Casey and Mark felt confident to go on this trip and have Steve and I run appointments and meet with people and take care of the office. That was a wonderful vote of confidence, and I appreciate that very much. I got to meet some new folks, talked with some clients who've been with me for some time, and did some things at home. With the weather finally turning, it finally felt like a fall in Seattle this weekend. There was some mist, there was some fog, so we had a nice fire going and did some things inside the house. And my wife Jo and I enjoyed that very much.
Don't let Craig kid you, man. He would have rather been in Bora Bora. I don't care what he says.
I was a little jealous, I gotta say, but I'm looking forward to next year.
That's right.
Yeah.
Exactly.
Yeah, I'll tell you what. Coming back to the gray, rainy weather,
The
from
big
Bora Bora.
dark.
Yeah, that was a rude
big
awakening.
dark.
Yeah, but it's always nice to be home, right? So here we are.
Well, and you came back to the office, it wasn't smoldering, right?
Yeah, that's true.
It's not like Steve and Craig burned it down. All right, guys. Well, listen, we have fun, but I mean, the serious part of this is, we talk about planning and being proactive. And this show in particular, we really kind of jump on the latest when it comes to, the news that's out there that's going to impact retirees. And guys, you've sent me stuff. We're going to talk about this today. The first one up is an article from Zero Hedge. And it's Seattle paying up to 53% more than the national average for gasoline. And you're like, hey, isn't this a retirement show? Well, guess what? You got to buy gas in retirement too, guys.
Yeah, you really do.
Yeah.
And it's just, I think this really highlights the point, just inflation in general, right?
Yes.
And so gas it's very noticeable across the country. It's really, really noticeable in Seattle. So kind of a quote from the article here, national average for gas is $3.06, $3.07. In Washington State, the average is almost $4.40. It's like 4.39. And then depending on what county you're in, where you're at, in King County, it actually reaches $4.73. So it's just really expensive, and we live in an expensive area, and that's really why this stood out to us, as we were going through things, because this really highlights the importance of having inflation built into your plan, making sure that your income is growing, because if you don't have inflation built in, then realistically what you have is you have a plan to do less in retirement. So you're going to start at the top and you're going to decline for the next 30 years because your income's not going to keep up. And so this is a big piece, and you add that on top of housing prices and what it costs to buy a loaf of bread or a carton of eggs, and it just all starts to compound and really, really brings into focus that if you're moving into retirement, you got to make sure that you have what you need.
Yeah, it's. I think what's important here is this brings up the tax issue, right? Because we know we're one of the highest for a gallon of gasoline because of our gas tax. That's a known fact. But what was just interesting, the group that studies taxation in all 50 states, Washington, the bottom line was number 6th worst state in the United States to live from a tax perspective. New York, New Jersey, California were the top 3 worst. But it's interesting, Washington is not far behind. So again, I want to piggyback what Casey just said. You've got to have some tax help, and you have to have some tax mitigation, because living where we do here with this type of inflation and the added taxes, we're working with a couple right now because of the Washington State inheritance tax. Most people of our clients are not going to ever have to worry right now about federal estate taxes, right? Because they're not going to be over, $28 million, $29 million, but over $3 million, that's a whole different ballgame, right? And so you better be working with someone that can help you when it comes to taxes. And we're very thankful and proud. We have a CPA that's in our office. And so, again, tax planning is a huge part of what we do here.
Well, it's all about, making sure you're prepared. And if you live here and you're in Seattle, you understand the pricing. You understand the reason behind the pricing, because I'm reading this article. I mean, just the state's carbon pricing policy, adding to the tax per gallon before it even reaches the pump, you're going to pay even more. So if you want to live in one of the prettiest parts of our country and you want to retire in the Seattle area, you've basically got to go ahead and pre-plan to pad your accounts, guys. And I know you talk to your clients about that. If you are going to stay in the Seattle area as a retiree, you've just got to have more.
Yeah, you do. It requires more assets. And you know what? I would say it requires, to some extent, a higher level of planning, because it really does factor into how this whole thing looks for you. And You know what? I was actually meeting with a client not too long ago. He works at Boeing, really sharp individual, and he put it really well. He said it's kind of like a whip. And so what he means by that is that when you make a change in the first couple years of your retirement, it's just like a whip. It's a small movement up front, but at the end, the whip, the end of that tail has a big movement. And it's the same thing when we make small adjustments today, where maybe we have this huge inflation spike for a few years, that can drastically affect the retirement that you're going to have 20, 25, 30 years from now. That does have a change. So that's where having a plan comes in. And that's really what this is all about. So this is your opportunity. If you've been listening to the show for some time, this is a chance for you to get a financial plan put together by our team of advisors. We will sit down with you. We'll give you an hour of our time and we'll discuss what you want your retirement to look like, what taxes are going to look like, how to account for that inflation. The biggest question, how much can you spend? And make sure that you don't run out of assets. What type of risk are you taking? We'll walk through each and every facet of it with you, all at no cost. It's completely complimentary, so don't hesitate. Pick up the phone and give us a call.
All right, here's the phone number, 866-668-3625. That's 866-668-3625. As Casey said, it's a complimentary appointment. There's no obligation to become a client. This is an opportunity for you to test drive Elevated Financial Management, see if it's a good fit. And again, you're not obligated to become a client. 866-668-3625. That's 866-668-3625. And if you set that appointment, ask Mark to show him the Bora Bora pictures. That's all I'm going to say. We are back on Elevate Your Wealth, powered by Elevated Financial Management right here in Seattle, and that's exactly where you can find our hosts, Mark Stimpson and Casey Elkins, along with Craig Roth, our special guest on this week's program. They got well over 42 years combined experience in the retirement planning business. They are certified financial fiduciaries. I'm Morgan Patrick. A pleasure to jump on and just talk about what it takes to retire. And we always say this, it takes planning. And if you're in the Seattle area, it may take a little bit more because it's we've already talked about it today. Things are more expensive. You're going to need more in your accounts. You certainly need to focus in on your planning. We're going to give you an opportunity to get on the calendar with the team at Elevated Financial Management. And the appointments we open up through the radio show, they are complimentary and there's no obligation. And as always, we kind of get into these articles, the latest when it comes to retirement planning. And this next one, guys, is all about the stock market. It's from Mark Hulbert. And the stock market is more overvalued than at almost any time in U.S. history by virtually every measure. If that doesn't stop you in your tracks, I don't know what will.
Yeah, this is something that I think is, I hope our listeners are paying a little more attention to right now. I love this first sentence. The fact that corporate profits are strong and growing doesn't mean the stock market isn't in a bubble. And there are many on Wall Street that, for whatever reason, just think that this is going to continue on. In fact, I love they said this. It says, many of the Wall Street cheerleaders are arguing we can't be in a bubble if corporations are as profitable as they are. And it says they don't trace, weak earnings per se, but to how far ahead of those earnings the market rises. And so, again, I just think we're in danger territory right now. I think we all, if you look at PE ratios, they're as high. We look at somebody like Warren Buffett. I think why does he have a lot of cash on the sidelines right now, right? I think he knows the market is overpriced. And when it does correct, he's going to make billions because he'll come in and he'll buy companies, he'll buy, shares. He's always been smart in that regard. So I know we're a little worried about a market bubble. I believe a bubble does exist. I'm going to share something in a moment to back that up even more. But I think Casey's probably got a thought on this as well.
Yeah, it's. I think here's the thing. Maybe it's a bubble. Maybe it's not. We can go back and forth all day. I'll say that. Yeah, we definitely believe the market's overvalued. Are companies profitable? 100%. But were companies profitable in 1999, right before .com crash? Absolutely, they were. So that's not really the marker of whether or not something is coming, right? But history does show that we do have corrections in the market, and there's always a reason for them, quote unquote. And maybe you don't see the reason on the horizon, but here's the thing. Do you think, speaking to our listeners, to our clients, do you think that the market's going to continue upward indefinitely through your retirement? Everybody's going to say no to that, right? Absolutely. There's going to be some level of reversal or correction. The question is how big and how long? That's really what this comes down to, right? So we don't know the answers to that. But what I will say is this: if you're 20 years from retirement, probably not a huge concern for you, right? Because you have time to make up for losses. Not that it's fun to lose, but you have time to make up for that. If you're 5 or 10 years from retirement, or 5 to 10 years into retirement, you do not have that luxury, right? And that's really what this comes back to, is making sure that you can be successful despite what's coming. I know you have something you want to add too, Craig.
Yeah, thanks, Casey. Today we're talking really about 3 of the 4 biggest risks to retirement that we discuss during our classes, during our workshops, right? Inflation, taxes, and risk of loss, right? And in this example, I think we have some of everything. We believe stocks are good in the long run. There's an old saying that, stocks are a great hedge against inflation over time. And that's true, but it depends on just how much time you have, right? Like you just said, Casey, if you've got 20 years, it's not as big a deal. But if you just retired today, the next 20 years are a very different proposition. In that article from Mr. Hulbert, it says, that when the market peaked in early 2000, over the next 12 months, the total return lagged inflation by 19%. Over the next 5 years, there was a negative return of 4.6, and even over 10 years, a negative return of 2.8%. So over 30 years, it caught up with inflation, but over 10 years, it lagged terribly.
It was a disaster.
It depends where you are in your life.
Yeah,
That's it. Yeah, the timing of it's so important.
Yeah, I think Craig mentioned something. I think we, in our classes, if you just, and anybody can look this up for themselves in Yahoo Finance, but if you look at 2000, it is incredible. The S&P 500 was 14.69 the start of 2000. 13 years later, it was 14.69. What does that say? Over a decade, 13 years, the S&P didn't make a dime. So everybody, you have to be so concerned about these type of numbers matter. What we call sequence of return risk is very real. And if the market doesn't perform the way we want it to, which means going up, when we start our retirement, it can devastate how short a shorter lifespan that your retirement might have, because those downturns happen at the wrong time. And that doesn't get talked enough about, we don't believe, by Wall Street. And it's something everybody listening needs to think about and be concerned about.
Yeah, and I think that's really it, right? Is that we don't know. And that's the point that we're trying to make, is we don't know, you don't know, nobody knows. It's a lot of fun for people to speculate that things are just going to continue forever and it's going to be amazing. And it's a lot of fun for other people to say, oh, well, it's all going to implode and we're going to lose 90% next week. The truth is somewhere in the middle, right? And that's the question, is how does it affect you when it happens? Because something will happen. Maybe it's only a 10% loss. Maybe it's a 40. Maybe it's more than that. I really don't know. But the point is, are you going to be successful on the current path that you're on when something does happen?
Yeah,
that's why we're always coming back to a plan, because that is what gives you the confidence and that correct investment allocation, that asset allocation, to make sure that not every dollar you have is open to the full risk of the market. That's the big key behind a lot of this.
When you have people come into the office and you have these types of conversations, I can see the light bulb going off. But the big challenge is to get them to come into the office, because it's almost like, look, we keep saying it. It's coming. The correction's going to happen. We don't know how long it's going to last. We don't know how far it's going to go down, but it's coming. But it's almost like we're screaming at the clouds right now, because we've been on this incredible bull run. It's almost like people are like, yeah, whatever. It's been 15 years with a couple of blips. It's going to keep going up. I mean, once they get in and once you start having these conversations, that's when they realize, the plan has to be in place for the what if.
That's it, right? And I appreciate you saying that, Morgan, because you know what? Craig actually met with an individual not too long ago, and I'm going to steal your story, Craig, because you shared it with us. But a quote from this person, he said, "I feel like I'm sitting on a powder keg," when he talked about his investments, because he recognizes there's a lot of risk in the investments that he has, and something is different, right? He's almost ready to retire. He's on the short term or short horizon to retirement, and so that risk that you're taking becomes amplified, right? And if it doesn't go your way, it can really be an issue. And so, I'll just mention it real quick. You mentioned it earlier, Morgan, breaktheglassbook.com. We talk about this exact thing in our book. We give real scenarios, we give details, and things that have happened to people in the past that just had bad timing, right? That's really what it comes down to. So breaktheglassbook.com. If you go there, you register for it, we'll send you a copy. And of course, we're always open to have folks come into the office and chat, but the book is a nice way to just learn a little bit more about exactly what we're talking about.
Yeah, I'd like to just maybe share one quick thought here. There's a team at Morgan Stanley. They're almost like a family office, but they manage about $7.5 billion. So this is a big amount of money. And I love what they say at the end as they help clients. They make this is some good advice for listeners. Avoid concentration and leverage. It can get you in trouble if you have too much stock and maybe one company stock or two even. It can end up being a problem. But this is what I love them saying. Most of our clients come to us to preserve wealth. It's not about beating a benchmark. It's about helping them sleep at night. So please, if you're out there, you've been listening to the show, you're maybe concerned a little bit about what to do. If you're getting ready to retire, have retired maybe recently from Boeing or any of our great companies, come in, see us. Let's have a conversation. You're going to keep your checkbook at home. We're just going to have a conversation, kind of like what we're doing right now. And we're going to look at taxes with you. We're going to look at, do you have guaranteed income stream that you can count on no matter what the market does? This and so much more. If you'll come in, let's have a conversation. Let us help and make your retirement something that doesn't just turn out to be a fairy tale.
Tell you, it's about grabbing an appointment right now. We've got 10 of them. They're complimentary. Call our number, 866-668-3625. That's 866-668-3625. You might be in a large group of people that have done an amazing job of putting your monies away. They're working for you in these retirement vehicles, but it's not a retirement plan. That's called a portfolio. What's your risk level right now with the barometer where it is? We're talking about it today. It's nervous time. Make sure you have a plan that takes that into account. Make sure you know exactly where you are on your horizon and how risky you can be and should be in your retirement planning. All right, call our number, grab an appointment, 866-668-3625. That's 866-668-3625. When we return on Elevate Your Wealth, the U.S. economy speeds up despite the shutdown, but tariffs weigh on exports and business confidence. We'll talk about that when we return. We are back. Elevate Your Wealth, you're tuned to it. It's powered by Elevated Financial Management right here in Seattle. Your hosts are Mark Stimpson and Casey Elkins, and we have Craig Roth as a special guest. He's also in that office. We've got over 42 years combined experience between these three. Certified financial fiduciaries, and it's all about getting Seattle ready for retirement. I want to tell you about a website. It's a resource. EFMNW.com. That's EFMNW.com. There are links to the TV show. Our radio shows are in podcast form there. But again, good information on retirement planning, background information on Mark, Casey, and the entire team. And it's all about preparing Seattle for what is coming, and that is retirement. And we're talking about kind of that environment that we're currently in. And guys, the article that you picked out for this segment, U.S. economy speeds up despite the shutdown, and tariffs weigh on exports and business confidence. And this is from Jeffrey Bartash. And this is interesting stuff. We've got some interesting numbers here.
Yeah, this really ties in with what we were just talking about, where it almost feels like things don't make a lot of sense right now.
No.
In a lot of ways, right? In a lot of ways. But we have people come in that are like, man, how long can this market keep going like it is, right? We feel the same way, right? I mean, it's very strange what's happening where there's you have people calling for like an overall economic breakdown, and yet somehow the market remains on fire. And even when the market trips up, it turns around and ends up being hotter than it was
The next day.
Yeah, I mean it is wild, right? And so the economy is really speeding up. I mean, people are still spending, but we are hearing reports of different things, right? We are hearing reports of more repossessed cars. We are hearing reports that dealers aren't moving cars as much as they were, which that's a pretty good indicator of people not being willing to spend their money right now, right? And people being concerned. Those repossessions on cars are generally a precursor to housing issues, right? And so that's usually where it starts, because people will cut there. They'll cut eating out first, then they'll cut the car, and then the last thing, of course, is housing, right? So when you start to hear those type of reports and things, it becomes very concerning. But then it doesn't really make a lot of sense with everything else that's happening, right? So that's why this really sticks out to us, because we do see all these things that realistically should be causing a problem, and yet somehow the market and the economy just continues to go up, which doesn't add up, right?
Yeah, it's a conundrum almost, right? You might say, but there is an important statement here. It says, business confidence in the outlook for the coming year has deteriorated further and is at lowest level seen over the past 3 years as companies worry about the impact of policies, most notably tariffs. Every business is still trying to navigate this tariff, right? Stuff. And so we don't really, again, this is something nobody could know for sure. Businesses are trying to plan for it, but it affects, hiring. We could go on, but there's a lot of uncertainty, and uncertainty usually creates what in the market? Well, we know it usually creates volatility. So if that's the case, do we have a plan for our own, especially retirement portfolio, to weather if this market gets really topsy-turvy? And that's what we want our listeners to know. Do you have a plan that's going to allow you to be successful, get the needed income every month that you need? Because isn't it funny, even though inflation goes up, we could go on about prices of things, but we still have to pay our mortgages. We still got to pay rent. We still got to eat, right? So that income needs to come in. And so if you don't have a guaranteed way to make sure that income comes in each and every month, and we're tying our income to market assets, that can lead to disaster for a lot of folks. And so that's all we want our listeners to be thinking about is, do you have a plan to deal with maybe an economic slowdown, or tax changes, tariffs? We could go on. Do you have a plan? That's what we're talking about.
Buy that gas.
Yeah,
$4.50
exactly.
a gallon,
Yeah, right.
Exactly. And I saw something interesting yesterday. In spite of the shutdown in government, the national debt rose $680 billion.
How does that happen? During the shutdown?
I really don't know. I
we were-
guess some of it is interest on the debt, which
Right,
is
sure.
now over $1 trillion a year. But my goodness.
Yeah.
It is crazy.
we were shut down for 40 plus days.
Yeah,
Yep.
exactly.
And
Yeah.
I mean, it was down to crunch time, but we're having a money crunch as it per se as a country, and now just kind of put it in your own big picture. How does that look for your retirement? And we know for a fact that there are a lot of you out there that are just sitting on portfolios, and the percentages of people that are using professionals to help them plan retirement, it is small.
It is. Yeah.
So the pool that we're talking to right here in the Seattle market is quite large. I mean, you've done well. You've saved your money, and it's away in these accounts, tax deferred, most of them. But how are you going to handle it as you get closer to retirement? Man, be proactive. Get ahead of this. Come in, grab one of our complimentary appointments, and start to map it out. Now, if you are in the planning process, but you're frustrated and maybe your appointment's getting moved around, your calls aren't being returned, and I get it, you're concerned, so you're calling. Get a second opinion. We offer that today on the program. And we also offer you an opportunity to grab Break the Glass. We talk about this as a reference book. Again, this is something that you can really kind of lean into when it comes to retirement planning. It's Break the Glass, and it's simple. Here's what you do. You go to the website, breaktheglassbook.com. That's breaktheglassbook.com. Just enter your information. They'll ship a book out to you. It's complimentary, and it's an opportunity for you to kind of do some reading. Take a look at your own life, your own savings, what you're doing or not doing for retirement. And if you need to get the ball rolling, guess what? Elevated Financial Management right here in Seattle, we're here for you. We're ready for you. It's an opportunity to get on their calendar and start that process or get that second opinion. But guys, it goes back to the economy. It goes back to, it's almost like we're on this never-ending wave. Mm-hmm. And eventually it's going to hit the beach.
Right, exactly. Yeah, something has to happen, right? What goes up must come down. You know, whatever saying sticks in your mind, we recognize that something will happen at some point, and I think most people are on that same page. You know, I think what's so interesting about this article too is it really brings into focus something that has happened to folks that we've worked with. And I'll just share this, and then I'll kind of try to help apply it for everybody. But we had a gentleman who worked at Boeing for 44 years, I think it was. 44 years. Realistically, kind of his only job. You know, I mean, had worked other smaller jobs in high school and stuff, but realistically, that had been his whole career. And Boeing had their layoffs, and he ended up losing a majority of his retirement because most of what he had invested was in Boeing stock. And so when the Boeing stock went down after the door blew off the plane, that really impacted his retirement. And so that's when he came to us, realized he needed some help. And what I'll say is this, Boeing then laid him off. And this is when he was planning on working 3 more years. Mm-hmm. So here's why this really sticks out in my mind as we consider this article. We're talking about economic issues, right? Well, where do they go to lay people off that's going to save them the most money? Generally to the senior staff, right? That senior staff. So if it's the senior staff, and let's say you're 60 and you're planning on working 5 more years, you might be one of the highest paid people in your company or in the role that you're in or in the group or the team that you work on. It might be really easy to let you go. And finding a job at 60 is not as easy as finding a job at 40 or 35, right? It's very, very different. And especially when the economy is struggling and there's not as many positions. And now you're talking about a pay cut when you should be having the 5 highest earning years of your life between 60 and 65. So you might get forced into an early retirement. And what I'm really trying to say with this is you might be thinking, I'm 5 years from needing to put together a plan. It might be better to have the plan right now, right? It absolutely would be better to have the plan right now because we don't know what's going to happen and things are uncertain. So it's worth taking the time to get this all sorted out. I know you had something else you wanted to throw in there, Craig.
Absolutely, Casey. You know, we're talking today about a lot of different risks to people's retirement, their happiness, and their money. But the opposite of that is what's really true today. Right now, in this present moment, the market is at all-time highs. Mm-hmm. People do have all this money. They do have all this choice to make. And what better time is there to rearrange things for your benefit for the next 30 years than now? No. Yeah. Why would you wait until after the next bear market or after the next issue comes along?
Yeah, that's such a good point, Craig. That you have a lot of bubble wealth out there, right? A lot of people have made a lot of money. Why not turn some of that into real wealth? I want to go back to this article really quickly about the economy. I love what it says. It said the economy is in a holding pattern of sorts. It's not growing rapidly, but it's not also noticeably weaker. But here's the key thought. Businesses are waiting to see where tariffs settle before they hire more people or make big investment plans. And how it talks about the Federal Reserve has cut rates recently, going to do it again. But rate cuts alone probably aren't enough to jazz up the economy. So we need to be thinking about these things. And do you have a plan if this economy downturns for a little while?
Right, that's it. You know, it really does come back to a plan. And I think that's the key, right, is that's the roadmap. Things change, life changes. We build a plan and suddenly somebody has health issues or they get laid off and the plan has to be adjusted. But that's the key behind all of this, is that you're actively working towards a solution. Sticking your head in the sand doesn't change anything, right? So this is your opportunity to get a spot on our calendar, to come in, to meet with our team, to meet with the fiduciaries that we have here at Elevated, to talk about how you're currently invested, what type of risk you're taking, what the expenses are going to look like for you in retirement, how you can keep up with inflation, what do you do for Medicare? All those questions, the things that we talk about on the show regularly, what we teach at our retirement classes, what we talk about on the TV show, all of those things, we'll sit down, we'll build a custom tailored plan just for you so that you know what all of this looks like. And it's all at no cost, completely complimentary. So don't hesitate. Give us a shout.
All right, here's the phone number, 866-668-3625. Again, these are complimentary appointments. Again, no obligation to become a client. Call our number, secure one of these appointments right now, 866-668-3625. We get it. We're concerned about the economy. We're talking about it today. How does that pertain to planning? You need to be thinking about that. Grab one of these appointments, come in and talk about your situation. Are you ready for retirement? Do you have a plan? Call our number, 866-668-3625. That's 866-668-3625. When we return on Elevate Your Wealth, we're going to get into some scenarios. I'll throw them at the fellas, see what they come up with next. Welcome back into Elevate Your Wealth. Your hosts are Mark Stimpson and Casey Elkins, and our special guest is Craig Roth, all from the office right here in Seattle, Elevated Financial Management. The website, treat it as a resource, efmnw.com. All letters, efmnw.com. Links to the TV show, also our radio show in podcast form. They got well over 42 years combined experience between these three, and it's about helping their clients get ready for their retirement, helping Seattle to retire. They're certified financial fiduciaries. I'm Morgan Patrick. Absolute pleasure to jump on. We are in our scenario portion, and these happen all over the country. We've gathered a handful. We're going to see how the gentlemen will handle them. Mark, you're up first, and Casey and Craig, you guys feel free, jump in. 68, planning to delay Social Security until age 70 to max the benefit, but their portfolio down 14% this year. They're wondering if tapping retirement accounts now will cause more harm than good in the long run. So here's the question. How should someone weigh market losses against delaying Social Security?
Yeah, this is when you see down 14% this year. This is a scenario, right? Because if you're down 14% and you've been doing it yourself, you should probably fire yourself right now. Because most portfolios have been up for this year. But this is a really important type of question, though, because the bottom line is that's what people want to know. Because if you're taking income off of those investments, let's say stocks in this instance here, you're going to be locking in a loss, right? But there's some cool things that can be done with tax loss harvesting, you might say. So there's a lot more information I would really need to answer this 100%. But what I can tell you is there's several in our office are nationally certified Social Security advisors. I know I turned my Social Security on at 68. I was going to wait. I got a little worried about offices closing and not being able to do certain things online. I would have probably waited till 70. But you have to look at this from an individual perspective. Your situation is not like anybody else's. So there is no cookie cutter answer, as we talk about all the time, as to when you should or shouldn't turn on Social Security. We do tend to lean toward, especially if they have money in 401ks or IRAs, other type of qualified plans, possibly letting the Social Security roll up. Because the wonderful thing about Social Security, once you hit full retirement age, for most of us, it's going to be 66 or 67 years of age. After that, your Social Security is guaranteed to roll up at 8%. Now, are we guaranteed 8% on our stocks? Well, they can do better, but they can also do a lot worse. So I like that guaranteed 8% annuity roll-up rate, right? So again, it may or may not make sense, but I need a lot more information to know what's the best way to maybe fill the gap, because that's what we're talking about. right, is filling the gap of the income that you need. Where do I take it from? Should I turn my Social Security on and be set at that number going forward? Plus, we know Social Security has a COLA to it. But again, there's so many things that come into play, especially from a tax standpoint, that this answer, I need more information, or we would need more information to really help this client make the optimum decision.
Yeah, I would say, if they're 68 in the scenario, right? So 2 years before they get to 70, which they're not delaying Social Security beyond that because there's no benefit, right?
Right.
So if they're down 14% this year, they got 2 years to make up for that 14% loss. At 68, making up a 14% loss over 2 years, there's a fair amount of risk involved to actually accomplish that, which means that they're probably not taking that level of risk. I hope that they're not taking that level of risk at 68. So I would say probably makes sense to start the Social Security and not impact those investments while they're down, right? Because trust me, I get that you want to let that Social Security grow, but you also don't want to start to cannibalize those investments up front because it may take longer than 2 years to get back what you've lost. And especially if you start taking distributions from those accounts, it's going to take even longer. So, and as Mark said, there's more details to this. It would be a lot more situational than that, right? Everybody's circumstance is different. If you got lots of other money, then maybe that's okay, right? And maybe you have some accounts that are higher risk, so they're down more than 14%. You have some that are lower risk, so maybe they're only down 5%. It just all depends, right? It's very circumstantial, but just at face value, it probably makes sense to start the Social Security now if the accounts are down like that.
Well, and there are a lot of people out there, guys, that just feel like Social Security is kind of that standalone. It's over there in the corner, and you're going to have it whenever you want it, and you're going to take it whenever you take it. But you're saying the importance is everybody's different, and it has to work into your plan.
That's it.
How you're going to take it.
Yeah, it really does, right? It's got to be part of an overall plan. And that's, it's really easy to make these blanket statements like we've talked about on the show before. Like, what's the magic number for retirement, right? Everybody thinks, it's $1 million, and now it's like, well, maybe it's 1.5 million, or there's no magic number because your circumstance is individual to you. If you only want to spend $50,000 a year in retirement and you're going to have a good Social Security, you don't need $1 million saved, right? If you want to spend $200,000 a year in retirement, you need more than $1 million saved. So it all depends on what you want to do, right? And it depends on if you have a pension and how good your Social Security is going to be. And, is the money that you have saved, is it going to be tax-free in a Roth, or is most of it in an IRA? Because it's going to require more if it's in an IRA because you've got taxes to deal with, right? Yeah. So there's layers to this. There's different facets to it. And how do you build something that's going to last?
Right. Especially when you're talking about uncertainty in some big parts of that equation, right? We don't know what the returns are going to be. We don't know when we're going to have a good year, when we're going to have a bad year. And that makes a huge difference in how long the money's going to last.
Absolutely.
I tell you, it's important, guys and gals, have a plan when it comes to your retirement. Got a resource book I want you to check out. It's called Break the Glass, and we've got a way for you to log on, go to the website, put your information in, and they will send you out a free copy. Again, Elevated Financial Management, Casey and Mark, they wanted to put this book out, so they did. Break the Glass. Go to breaktheglassbook.com. It's breaktheglassbook.com. It's a resource for you. Enter your information in. They'll ship you out one of these books. And again, it's a resource. You can lean into this. Break the Glass. It's breaktheglassbook.com. Go there, sign up for that book. All right, next scenario. Casey, you can start off with this one. They just sold their home, $650K, and they're thinking about renting for a few years while the market cools down. But with inflation and uncertain rent prices, they're unsure what's more financially stable. So is renting in retirement a smart move, or should maybe downsizing into another home be the priority? And again, right now, the real estate market's in flux.
It is, and so I could appreciate wanting to wait some time. I get that. Where you have to be really careful, though, is you're almost kind of trying to time the market with this type of thinking, right? So to kind of just draw a different illustration, let's say we're worried that the stock market is going to fall next week, so we move everything into cash. Well, the stock market doesn't fall for the next 4 years, so you just sit in cash waiting, hoping that you were right? And so it gives you this kind of awkward thing where now you're stuck of like, oh, well, I'm not going to buy back into the market now because what if I buy in and then it goes down, right? And so it's kind of the same thing with housing where I can appreciate that we think real estate is overpriced and things are very expensive. And I think that is the case. Does that mean it's going to change in the next couple of years? It may not, right? That's the whole point, is we really don't know. So I could say this: if you were waiting to purchase a home because of interest rates, I would not advise to do that. I would advise against that, because you can refinance later, right? So don't miss out on the right house because you're worried about the interest rate. You can refinance when interest rates go down. Now, if you're worried that the overall real estate market is going to go down, how much is it going to go down? I don't think we're going to have another 2008, right? I don't anticipate that housing prices are going to get cut in half. So is it worth saving maybe 10% on the house or something like that? I don't know. Probably not. When you look at rental, because rental for a comparable house based on what was described here, the rent's probably $4,000 or $5,000 a month in our area, right? So I don't know. You're probably not really saving that much, because you're going to spend that money on rent. You're not paying it towards yourself, towards a property that you're going to own. And so that difference has to be pretty substantial. The equation you want to figure out is how much the real estate market would have to go down to make renting for 2 years viable. And that's a pretty sizable number that the real estate market would have to drop. So it probably doesn't make a lot of sense. Now, there can be other factors. There could be other reasons. There could be other things that come in. But just on the surface level of what's presented here, I would say it probably doesn't make sense to wait.
Yeah, I think renting, if you're not sure what you're going to do,
right,
and you don't want to make a decision, right, and
then
maybe
that would
buy
make
something,
sense.
then you want to do it. We have a friend right now that's trying to get into a Rambler. Ramblers in our area are very hard to find that don't need to pretty much be gutted and redone. So if you sell your house, then you can, maybe rent, or in his case, be able to rent back his house so he doesn't have to move twice while the Rambler is being remodeled. So there's a lot of different scenarios like you talked about, why, this is where maybe getting a third opinion from an unbiased party can help us when we really need to think about this, because there's a lot more to retirement planning than just the money part of it. And when we're talking about one of the issues, where do we want to live? What do we want to do? How can we help our clients retire to something versus retiring from something? And that's a big part of what we do here at Elevated.
Right, absolutely, Mark. As you said, that the house is somewhere you're going to live, right? You're going to spend your life in it. So you want it to be a good space and one that you're going to be happy to come home to every day. Plus, rents are going up almost every year, if not every year. There's inflation there. So generally, we like to talk about downsizing, take some of that equity, buy a new place that you're going to be happy in during your retirement, and then you have plenty of money to invest and help supplement your income.
Yeah, so if you've got questions right now, and we've talked about housing maybe, what about taxes? Are you worried about inflation a little bit? I want you to know we're going to have a conversation, so please pick up the phone. You're going to keep your checkbook at home, and all we're going to do is talk about your specific situation. So please let our team of certified retirement planners, and also those of us that are I'm a nationally certified Social Security advisor, so we're pretty good in this field. So please pick up the phone, give us a call. Let's just have a conversation about your own specific situation.
All right, this is your opportunity. Grab one of our complimentary appointments by calling 866-668-3625. That number again, 866-668-3625. There's no cost to this appointment, and you're not obligated to become a client. This can be a fact-finding mission about your retirement, and are you ready for it? And if you're just sitting on a portfolio, that's not a plan. If you're in need of a second opinion, grab one of these appointments and do it right now. 866-668-3625. That number to call, 866-668-3625. Another edition of Elevate Your Wealth, powered by Elevated Financial Management right here in Seattle, is in the books. For Mark Stimpson, Casey Elkins, and Craig Roth, I'm Morgan Patrick. See you on the radio next week.
Investment advisory services offered through Foundations Investment Advisors, LLC, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific opportunity, offering, or issuer. Any discussion of performance or returns is not indicative of future results. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in states where it is properly registered or excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. No legal or tax advice is provided. Always consult with a tax professional. All rights reserved.